kick off the new year. I have my team on here, so I'll go ahead and let everyone introduce themselves, and then we won't waste 1 minute because taxes is something that everybody is dealing with or is going to start dealing with soon. So without further ado, team, want to say hello?
Hey, Mohammed here. Good to see everybody.
Hey, how's it going? This is Albert. Nice to see you guys. Happy New Year.
So, Mohammed, you want to go ahead and introduce Mr. Micah Wainwright? I mean, we could just talk the whole half hour for on your credentials, Micah, because you've got a lot of awesome
things.
But
thank you.
Mohammed, go ahead and do this man, proud and say some things.
Absolutely. First and foremost, I do want to say it's a pleasure having Micah here. What do you say? He's not just a referrer. I'm also a client. Mike is, I've had the pleasure of knowing Micah for many years. I've referred plenty of folks to him over the years that I know could utilize his services, and he's helped out quite a few people that I've known for, in some cases, decades. Micah is, let me get this. Micah Wainwright, MST, is the managing partner of Good Steward Accounting and Taxing, and he's based out of Owens Mills. Micah has his bachelor's degree in okay, so I'm screwing this all up here, but Micah has his bachelor's degree as well as a master's certificate in management from Johns Hopkins University, as well as a Master of Science in Tax Law degree, which he obtained about 6 years ago. In addition to that, Micah is a published author and is working on his second book currently. I have his first book on my bookshelf. His second book is geared towards kind of helping to decode and declassify the secrets of the tax industry. And beyond that, he is a public servant in the community, being a pastor and a minister of a church in Baltimore. So he spends a lot of time investing in the community and, helping folks like us to, achieve our goals and understand the mysteries behind taxes, because let's be honest, taxes are mystifying. That's why we go to people like Micah to help explain it to us and help put us in a position of the wealthy to navigate the tax code. So with that, I'm going to turn it over to Micah, somebody that I am very happy to introduce, somebody that I put great trust and faith in, and very pleased to share him and his skill set with you this evening. Micah, take it away.
Awesome, nice. Well, thank you, Mohammed. This has been a very warm welcome, so I definitely appreciate that. And you introducing me to your network. So I hope I live up to all the expectation. We shall see. So with this group, I'm assuming everybody is involved in real estate investment to some degree. Is that the right assumption?
Actually, no, this goes out to our whole network. So, I mean, you've got some folks who are in real estate who are on the line, but not everybody I'm seeing. Okay. We got a lender on the line, a few realtors, I see a consumer, so we're across the board.
Gotcha. Well, that's good, because the presentation that I have that I'm going to go over tonight, it's for small business. And for me, small business is anything 250 million and below. So you got time, because some people, when they say small business, I ain't no small business. So, we got some room to grow when we say small business. And you can be a one-man or one-woman band and hit that $250 million mark. And I've got a handful of those clients I just got. Mohammed, you asked how things have been going. I was shocked that here I am out here in Owens Mills, and I've had clients. They've seen some Facebook things I've done, some LinkedIn things I've done, and they have flown here to meet with me. And I've had to just stop and say, oh, but you have family here and all that. And they're like, no, I came to see you. The most humbling experience that you can ever want. So it just makes me continue to want to live a clean life and do right by people. Because I believe scripture when it says, your gift will make room for you. And it's It's my honor to do things like this. I'm passionate about this subject. You probably will see that. And I'm going to invite you at the end of this to join our Facebook group, where I do no cost content in that group. Because again, I feel like tax, I coined myself as the Robin Hood of the middle class, but I said that on Fox News. I did a Fox News tour 2 weeks ago with 11 stations. And one of the guys said, don't take our money. So I had to think, oh, Robin Hood took all of the money from the rich. But when I say Robin Hood, I mean making those unreachable areas of the tax code available for the middle class. And a lot of people don't realize what middle class is. That's between 80 and 150. If you're there, and then anything beyond that, you know, it's like upper class and all of that stuff. But I've helped people get from that $80,000 a year mark to a 7-figure mark. And the biggest thing to do is plug the leaks in your finances. If I can save you, and I have one client, she does government contracts. She makes $250 a year. Making $250 a year by herself, her tax bill is 50 grand, or was before she came here, 50 grand on the federal side, and somewhere around 15 grand on the state side. What is that? That's like almost $70,000. That's a staff person. So of course, if you're already at 250, we're going to get to 800 real quick, because that person, we can replicate you. So already, if you're doing 250 on your own and we replicate you, that's $500,000 right there. And we just keep going and going, but we don't know how to do that. And on top of that, we're helping that person earn as well, and maybe they can buy stake in the company. So that's kind of my abstract, so we can get into this. If I hit share screen, will you? Oh, okay, yep. And
Micah, I'm going to speak from the thing, just so you know I saw a few people come in. I know a few people have a few burning questions, and I just wanted to warn you that 6:30 rolls around fast. So
okay,
it's okay if you speed through it, because we want to hear everything you have to say.
No, I'm glad you gave me that license, because Q&A is really how we win with this. So that's perfect, because I just want to hit a few concepts that most people don't know about. And once I expose that to you, at least you have some nuggets to walk away with, and then we get to the question. So that's good. Oh, I haven't seen it look like this. Can you all see my screen?
Yes.
Oh.
So you want to put it in a presentation view, because what is showing your notes?
Oh, gotcha. Now, when you say presentation view, good Lord, I'm acting like I'm 85 years old. Okay. The biggest thing I want to talk about, I don't mind if you see my notes. The biggest thing I want to talk about for a lot of people is the proper entity for your business. Oh, it's picking up my anyway, whatever. The proper entity to set up. I think that every business really should start as an LLC at least. However, don't stay as an LLC. If you stay as an LLC, all it takes is a quick Google search to find out that LLCs are disregarded for tax purposes. And disregarded means there is no specific form to communicate your business's activity to the IRS other than on your 1040. Huge no-no. You don't want to do that, because the tax code is really written for two classes to win: the affluent and business owners. And what I like to tell people is, if you're not affluent already, at least you can raise your benefit up to that level by incorporating. And again, we have doctors, we have lawyers, we have people that do very well in their career, and it gets on their nerves to have to pay $3,000 and $4,000, but still they want to know, is there a way I can get out of doing this? And I'll say, yes, you need to incorporate and have a business. And sometimes you get met with the arrogance. Well, I don't really need to do anything else. And I'm like, well, okay, okay, keep paying $3,000 and $4,000. But if you have another 30 years left of work in your career, multiply that out and see how much you're really giving up. And you want to send your kids to college and you want to live well and you want to do all these things. So I like to go down that path to kind of say, you might be doing well, but you can be doing better by applying some good strategies. Just ask the sitting president. You know, a lot of the strategies that he uses, he's not locked up. He does everything according to the book, and that's what I do. It just so happens that a lot of the strategies, a lot of people, they don't know about them, and it does take a little bit of gymnastics to do. It takes a little bit of work to do that. And what is that work? That work is incorporating. So you start as an LLC, but there's a special filing that I like to do to make that LLC an S corporation, and you'll see that little direction here, or at least a C corp. So just to consolidate this really quick, the S corp and the partnership are cousins in terms of their tax impact. They are going to be taxed at a capital gains tax rate, which is between 15 and 20%. But if you're somebody that makes 80 and above, you're already more than 20%. I know that already. You're probably somewhere around 28%, and the most it will ever be is 37.5% under the current law. That's partnership with the government. So nobody wants to have that kind of a silent partner, because they are truly silent. They don't contribute. All they do is take. So we don't want to be in that position. That is just not good business sense for anybody, for any industry. So the partnership and the S corporation are good for that particular thing. What happens if you don't do the S corp and the partnership and you brought in $1 million? Well, you're going to have that $1 million. In this example, to keep the math really simple, is going to be taxed at that 37.5%. So that's roughly what, $370,000. Whereas if we were to incorporate or partner with someone else, we're at 20%. So now you're at $200,000 in taxes. You've saved a fortune, a small fortune you've saved just by pushing some paperwork. And then look at that, that's like over 100 grand that you're saving. And here's another pitfall and resistance that I get. If the tax plan for that is going to cost you $2,800 and people clam up, but I'm like, you're spending $2,800 to save 6 figures in taxes. It just makes sense to do that. The other thing I want to share before we open up for questions is the C Corp. At some point when you're doing at least real estate, I know that for sure, you make a lot of money doing real estate. You make a lot of money lending money. Oh my God, all it takes is a few mortgages at a 7-figure range, and you've done very, very well. So sometimes we need a few different entities to talk to each other. So don't just think, okay, I've incorporated, all is well. Not at all. And sometimes I like to show 50 Cent's and Kanye's business model. It is insane. They have stuff going every which way. And at some point, that's where many of us who are entrepreneurs need to go. You needed a C Corp for certain things, you need an S Corp for certain things, and you need a nonprofit. Sometimes you just need a foundation. Let me talk about that. That is something that is not really talked about a lot. The example I can offer to explain the nonprofit portion would be my principal. I have a client who's a principal. She makes a good mid-range 6-figure salary, and she helps a lot of parents at the school. She helps them with the rent, with food, all of that. And we're doing taxes at the end of the year. And she gives me, $8,000 to $10,000 in canceled checks that she has, helped families out with. And I'll just look at her and say, isn't that precious? You can't reduce your income when you give gifts to a person. So in her case, it never dawned on her to start a private foundation. The Jewish families do it all the time. Why not help me while I'm helping you? It just makes sense. So for her, she's got the private foundation, and she also happens to be a real estate investor. So she's got the foundation, and she has several different LLCs. And let me show you what that would look like. This is where we're going, at least from the strategy I like to employ. You want to kind of reduce your liability with the houses. So you see here, I'm assuming that the business was a real estate investment company. And notice at the top, this is a management company. And I have here no properties. You never ever want to put properties in a S or a C. And we can dive into that during the one-on-one. But just remember that is a no-no. An S Corp or a C Corp, it will change your life for the worse. So let that just be the management arm. And we can talk hours of why that works. But the most important thing is making sure that each one of these boxes, if you're in DC, the DC market is a very rich market for real estate. So each one of these is probably, you don't want to put any more than maybe $500,000, maybe even $1 million for those properties in DC. In the Baltimore market, I usually don't like to put more than $250,000, like 250 in each one. But 250 in each one, that might be 3 or 4 houses. Because in Baltimore, you can snatch up a whole block for 250 and have about 5 or 6 houses. But the strategy with this is to make sure we have both asset protection and tax mitigation. So that's pretty much the abstract. I guess we should open it up for questions now with the last 13 minutes.
Well, I just have a really quick burning question, and that is, when you say, can anybody become an LLC, or can anybody become an entity? Like, if you're just a regular person and you have, and so at what point should you become an LLC or put your money?
Oh, yeah. Oh, I love that question. Because I've actually kind of come up with a nice little rule of thumb for that. And you won't find this on the internet. This is just 20 years experience. So for me, again, I look out for the working person on up to middle class, and then get you all the way up here to, being wealthy. So a lot of people are doing Etsy, they're doing, Amazon, and they're like a school teacher, they're still doing that. And so they might be making an additional $7,000 a year, $8,000 a year. For them, it will be too much of a shock to their system to now be incorporated and be this business owner. They're just going to fail. And I know that. So I say for them, anything under 10 grand, I say just be a sole proprietor, because you can still win. You're not really making any waves yet financially with that side business. It's really kind of like a hobby, but I'm turning it into a business so that it can help you out. Less than 10 grand, don't worry about incorporating. Though I do think it's a good idea to, if you think that someday you're going to go over 10 grand. Then I say right at 10 grand, at least become an LLC. Because what that does is it gives you, like my lawn care people, we haven't gotten into tax mitigation yet, but we have gotten to asset protection. So if you're mowing lawns and you knock over somebody's heirloom statue of Mary, and it might have only been $200, but they're so distraught because it was grandmother's statue, and so now they're going to sue you, and you're cutting grass. You're probably doing 60 grand a year cutting grass by yourself, which is decent for grass, and it's a seasonal thing. That lawsuit can wipe you out. So at least do the LLC so that if they sue you, you have a firewall and they can only get what's in that LLC. You just close that out and go somewhere and start something else. Then I say 50 grand is when I want you to be an LLC with either an S attachment or a C attachment, because at that point, your life is changing. You have an extra 50 grand on top of what you're already making. And now we're going to have asset protection and tax reduction. Does that answer that question for you, Ebony? Good stuff. Any other questions?
You were,
Go ahead.
no, please go ahead.
Oh, well, so I was just going to ask, going back to the chart that you had with the S Corp or the corporation, and then you had the LLCs, and in each LLC, you gave the example of maybe 500K,
Yeah.
250, depending in Baltimore. So when you talk about that number, are we talking about the property value, the mortgage amounts? What are
Yeah, that's good.
Yeah.
I'm talking about the property value because I'm trying. Ooh, and I'm going to tell you something else too. I'm talking about the property value because I'm always in court. When I set up a tax plan, I'm in court. And I just recently got out of a battle myself. Why somebody would play with me, I don't know. But of course I prevailed. But I always do it from the context of what would I need to show a judge and what people are after. Greedy people. They see you doing well. Your life is starting to change. You're coming to work. You're supposed to make the same thing I'm making. And now you done bought 2 vacation homes. And people just do real nasty stuff. And when you start digging, you'll find out that it's somebody that's close to you, that is doing these things, setting you up. So yeah, definitely, I'm always looking at what is someone going to gain from my portfolio. And that's another good reason why you want to break this up. Because if this, let's say this whole portfolio is worth 2 million, you don't want it at this level, because at this level, you got access to everything. So now if somebody sues ABC Management Corp, and you have everything up here, then they have access to the whole 2 million. But by having ABC Management Corp incorporate this one, and this one, now we have a firewall. So I have divided my 2 million up so that if somebody came and slipped on a piece of grass over here at Oak Ave, and this portfolio out of that 2 million, maybe this is, 90,000. Then cool, I've mitigated my loss. And then you want to look at the fair market value too, not what you paid for it. What is a judge going to force you to sell that for and settle a judgment? And the point I want to make while we were looking at that grid, because my background is tax law, I kind of go deeper with my advice. You still have a lot of tax preparers and a lot of accountants that are still driving you to places like Delaware and Nevada because of the Series LLC. And they sell that as a benefit. But I'm sitting here thinking, I'm like, you have a $2 million portfolio, and the benefit is supposed to be, well, you don't want to pay $300 for each one. In that example I show, it was 4 entities, 369, $1,200 a year is what it's going to cost to manage that. If you can't invest $1,200 to protect a $2 million portfolio, stop playing, get out the game. Because that's what it takes. Because Maryland in 2014, the General Assembly, they have already said, we're not playing with Delaware. If you go to Delaware and you try to do that Series LLC stuff, we're going to collapse everything as one company. So get out of Delaware if you're going to do real estate.
Micah, let me ask you a question with regard to C Corps and S Corps. You gave some caveats in the beginning. Can you break down the benefits of having a C versus an S Corp and vice versa?
Yeah, the biggest benefit, Lord have mercy, in the context of where we are now with the tax law, the biggest benefit is that the S Corp is a pass-through. Just very quickly show you how pass-throughs work. So it's a pass-through. So here we are over here on our 1040.
Schedule K, basically.
And we have, $150,000 in our income. But we have the S Corporation. And the S Corporation, by the time I write off your vacations, because as an S Corp, you're supposed to have 1 annual meeting. I always make my annual meeting where I vacation, so that whole vacation is to be written off. Then what I do, a lot of other accountants, I see them, they say, charge yourself rent, lease out your basement to your S Corp. Well, that's not smart. It sounds tantalizing, but if you're leasing it out, if you have a lease expense on one end, guess what the inverse of an expense is? Income. So you have a lease expense for the S Corp, but you now have generated income for yourself. Stop playing. All cash is not income. So you pay income tax on income. So it's my job to reclassify your cash in a bucket that will not trigger income. So that's the first thing. So we want to have a reimbursement. We don't want to charge rent. We want to, and this is another reason why you want to be an S or a C, but in this case, we want you to be an S so it can pass through. If it passes through and comes over here in this 1040, let's say you have about $25,000, which is not hard to do if you made 150. If it passes through and it does that, where's my little? There we go. So now we got you down to 125.
You want to share your screen so we can see?
Oh, you can't see that? Oh, it stopped sharing. Here I am thinking. Okay. Can you see that?
Yes.
Okay. So here's the 1040. You made 150, and then we had 25,000 in expenses. That 25,000 is comprised of your vacations, the reimbursements to yourself. And how do you reimburse yourself? We have to hire you by your own corporation. And when you're hired by your corporation, let's say your monthly mortgage is $2,000. And if your monthly mortgage is $2,000 and your basement represents half of your square footage. And so now we've got $1,000 a month, because as real estate investors, we have all kinds of scraps left over from stuff. And so most real estate investors will use their basement. Now, I don't want to stay on that business too much, since everybody's kind of different places. You can be a chiropractor. You can have any kind of business. It just may not be half of your house. The rule of thumb for me that I normally see is like 20%. Is what most people are able to write off on their house. So if you've got a mortgage of $2,000 and I'm able to write off 20% of that, that's $400, but it's $400 each month. So for the year, that's $4,800. We haven't even gotten into the organic expenses to run that business. We haven't gotten into any of your licenses. We haven't gotten into any supplies, office, none of that. That's just the mortgage. Then we're going to get into maybe some food and groceries, because when you're home working and you're doing 4 hours of work at home, you're going to reach into the refrigerator. You're going to go to the bathroom. So the toilet paper, all of that, a whole year's worth of all of that. So probably, and so you see the mortgage, I got $4,800. The vacation is probably another $3,000. So now that's $7,800. Now this shocks a lot of people, even my attorneys, because this $25,000 can sometimes be $40,000 or $50,000 in write-offs. The most I've ever been able to write off for a client doing an S corp was maybe about $90,000, $95,000. And it has been challenged. I win my audits. Knock on, where's some real wood at? Oh, geez. I've won every audit because we don't push envelopes and be aggressive. We go deep, and you got to stop playing with the publication. One of the things I learned in law school was that the IRS publication is commentary, just like my book that Muhammad has on his shelf. It's commentary. So I get to argue with you. You're now my colleague. I don't agree with you. So we got to go to court and let the judge decide who's right. And so so that's the S corp. The C corp is not a pass-through. I don't recommend playing with the C corp until you reach a certain level, because a C corp comes with this double taxation. So let's use the S first and get to a certain level. And when we get to a particular point, when we hit that 7-figure mark, we might have to start looking at a C corp. And when we do the C corp, now we have a management company, which is the S, and then I'll have an operational company, which would be the C. The C corporation, you can expense your medical expenses. The S corporation, any medical expense that you pay yourself or on behalf of yourself is actually going to be considered income. So that's the only kind of backfire boomerang. But we got ways of getting around that too.
The C corp, if I'm not mistaken, the C corp allows you to basically reduce income into the form, basically package it in the form of owner's equity, which allows you to have access to it without paying taxes, correct?
There are ways of doing that. We can come up with like cafeteria plans, benefit plans. You have a lot of latitude. I mean, not too much different. But yeah, you can do that. But you really got to be making money before I'm comfortable recommending that, because with the S corp, we're at capital gains. You won't pay more than 20%. Well, for C corp, you can inch up there. And not only that, when you inch up there on the tax side, you have double tax. So now you're paying tax on the money, and you're also paying tax on the dividends. So you're paying tax on the revenue and the dividends that you pay yourself. which could sometimes be unnecessary.
Gotcha, but that's only if you pay yourself.
Which you will, because if you don't pay, so how would you not pay yourself?
What if you had, for example, say, for example, a personal investment corporation set up through a C Corp where one housed the expenses, one housed the revenue, but the revenue through the secondary C Corp actually financed your lifestyle?
You could do that. You can, yeah. I wouldn't want to play with that though. And like I said, I haven't seen that work until you start hitting them 7 figures, because you can get hung up real quick because of the double taxation. Like it'll help on that side that you're talking about, but when you start getting audited, because here's the thing, IRS, when you present a tax return as an S or a C, you're dripped in blood. And it's like, dripping yourself in blood and then jumping out into the deep where the sharks are. You're asking for attention. So we want to be careful. And again, that's why I win my audits, because I go in a way where I know I'm going to be protected and I'm going to win.
So before we go, I know that there's one person, I don't know if he can get through on the microphone. Julio, are you there? I know you had a question. Uh-oh, he might be stuck on with the technology. Julio, can you ask?
Can you hear me now?
Yeah, we can hear you. Go ahead.
Okay, I got a big echo thing, but I think is it coming through okay?
Yeah, yep, I can hear you.
Okay. My question is about capital gains for a personal property in Virginia. I know that for a married couple, it's $50,000 for the couple. What is the rate after that?
You said the rate?
Yeah, like I know that they do a $50,000 for couples, right? For a capital gains relief.
Now, Virginia, that's getting on the state level. I'm not really an expert on Virginia. If we're talking federal taxes, I got you on that. Now, on the federal level, the highest that the capital gains bracket is going to go right now is 20%. And it's only going to reach 20% if your personal tax bracket reaches 37.5. So you have to be somebody that's making like 250 and up. Then I know automatically your capital gain is going to be 20%. If you're making, 150 and below, I know it's going to be around 15%.
I'm more talking about the sale of a property. When you sell the property and you make capital gains, I know in Virginia they give you a $500,000 relief. In other words, if I'm understanding it right, you don't pay taxes for the first $500,000. But then you pay taxes.
That's federal.
That.
Yeah, that's federal. But you have to file jointly. Yeah, that's absolutely correct, because each spouse gets $250,000.
Okay, and now, then, at what point? What do they tax you after that? What is that? Let's say you sell a house for $1 million and you're making like 400,000 or 900,000 profit.
Right.
You get 500 off. You're paying 400 in taxes. What is the rate that they tax you at that?
So the capital gains rate won't be more than 20%.
Okay.
If you're at 37.5 on your personal. So that's the first thing I have to do is calculate your personal tax return, because there's so many taxes. There's capital gains, there's income tax, there's investment tax, and some other kinds of taxes, a self-employment tax. So it's not just that one tax that is going to be calculated on that 1040. So for capital gains, I have to figure out what is the personal rate going to be first. And if you're at 37, then I know they're going to hit you with 20%. If I can somehow get your personal rate down, which is always my strategy, and that's why we're going to write off your life. Like in this example, if I can get you down And whereas you would have ordinarily been at 37.5, there are things I can do to drive that down. And then once I drive it down, now I can bring your capital gains away from that 20, and it won't be lower than 15%.
Okay. Now, I think if I read this correctly, also, there is a loophole where you reinvest
Yes. Oh,
and
yeah.
keep it for 2 years.
Oh, well, I don't know about that part, but yeah, there is a loophole. And then there are very strict rules that you have to follow in order to do that. You really have to kind of talk to your tax person at the top of that decision. Because if you slip up in one way, it won't work. But it's doable. You really have to plan it out.
Yeah, if I read it right, you got 45 days in Virginia to reinvest. But I don't know if you have to reinvest the whole amount,
yeah,
or
it's
the amount above
that
the
sounds
500.
federal. Yeah, unless Virginia is just so mirrored to the federal, but yeah, that's federal as well. You have to do it within so you have to identify the property you want within 45 days. You have to put an offer on it, and the date of your offer, it has to be within that time frame. Then after you've identified the property, you can't touch any of the proceeds. You have to have it has to be escrowed. And when it's escrowed and you direct, the title company to pay for the next property, you're fine. You roll it into the next thing and it never triggers capital gain tax at all.
Okay, that is the loophole. And you have to invest the whole amount, not just the
Entire
500.
amount. Yeah, because if you have anything, the whole shebang is over. You just wasted all that time paying title companies and lawyers and accountants.
Right, right.
The process that you're referring to, Julio, so that you can look it up, it's called a 1031 exchange.
Okay.
So
well, the 1031 exchange, isn't that whenever you're moving it, an investment property? This is his primary property.
Yeah,
Oh,
I believe.
yeah.
I believe for these purposes, they work the same when you're rolling it over, and we can go do some digging on that to help you out a bit more. But I'm like 99.9% certain that the 1031 exchange is what those are the rules that you're referring to.
Yeah.
Okay. It's kind of what I thought. I was just like, start reading this stuff, it becomes Chinese real quick.
And then too, you guys, since it seems to be a lot of people with real estate, make use of the self-directed IRA. It pains my heart to see so many people, scrounging up their savings to buy this property. No, dip into that 401k and self-manage your own investment, and give your savings account a break and use some of that investment money.
Okay. Thank you.
Okay. Well, I mean, like I said, there's a lot to delve into. We barely scratched the surface today. So we generally we go each month, first Thursday of the month. So definitely join us next month. And Micah, we put your information in the chat. I can't tell, I can't see any faces, so I don't know if there are any last minute burning questions before we end the call tonight.
Well, I do want to invite everyone to join my Facebook group. It's called Basic Millionaire Training. And the concept is, I believe that anybody that starts a business, you need to have, if you're going to have the goal to start a business, you have to go to the next level and expect at least to make $1 million in that business. And this year I made it easy on people because they said, Michael, your bar is so high. I said, okay, well, in the lifespan of that business, expect to make $1 million. No, at least $1 million, because it's so easy to do, especially with real estate. So Basic Millionaire Training, it keeps us on a monthly basis aware of how to keep most of that money in our pockets.
That's awesome. We'll definitely send folks your way. And, for people like Julio who have questions about perhaps selling property, is that something that you can assist with?
Yes, yes, I do have a presence in 7 states and 2 other continents. So like Virginia, I've got about maybe 6 clients there. I don't answer questions in Virginia on my feet because every time I do a return in Virginia, I'm sitting there with the Virginia code because I spend most of my time in Maryland.
Got it. We appreciate you coming on tonight.
Thanks for having
Micah,
me.
you were fantastic. We'll definitely have you back where we can delve in a lot
Awesome.
deeper than just what a half hour is worth. So we appreciate everyone. So we're kicking off 2021, and this is, I think, a good start.
Nice.
So please come back next month and join us in February, the first Thursday, and we'll see you then.
Okay. Good night, everybody.
Good night, everybody. Micah, thanks again.
Sure. Thank you.
Yeah, amazing. Thank you.